A very good morning, good afternoon, and a happy new year to you. Very good to have you on board. Thank you very much for joining the HYCM workshop with myself, Giles Cochran. We will be getting you ready for the ADP data that's coming up later, as well as putting into context some of the recent market moves. Just as folks are signing in, don't forget that any entries, exits we look at in terms of trades, taking, that all of this is from a educational perspective. So it's not that we're offering trading advice. So any entries, exits that you would like to look at, we are doing here, and just make that clear that there are opportunities in terms of education rather than strictly saying buy this, sell that. For those of you who are regular, of course, you understand the way these things work, and particularly the format of this webinar. If you're ever unsure, just ask a question in the Q&A box and I can explain it in more detail. We'll be looking at the ADP decision at 1:15 today. It's going to be very interesting, and just going to run through what's going on so that we're, really got the narrative down. Now, let's first of all just remind ourselves what's been going on at the start of the year. So the first thing to note, first of all, is I want to just point out a strong fundamental picture that we have. It's a sentiment issue. If you look at the end of the year, you see the dollar tends to fall, okay? So the predisposition and you see at the start of the year, the dollar, tends to rise, particularly if you just go a little bit later, say over into the 9th of January. You see, so basically what you've got this pattern of dollar selling and dollar gaining around the turn of the year. Now the reason for that is there is a incentive from an accounting point of view in the US to show an absence of dollars on your balance sheet. So dollars move out of US parent companies into daughter companies around the end of the month, and they come back at the start of the month once the accounting is done. So that's kind of accounting reason. You can see that look how pronounced that is over that period of time. You can just see, gosh, even over 50 years, a lot of weakness in the dollar, and again, even over 50 years, a lot of strength. So it is a trend that's worth noting. So as we've started the year, it hasn't been a massive surprise from dollar strength. Now, we have seen another couple of characteristics. So we've also seen some yen weakness. Now, a lot of this has been the rise in the US 10-year yields, and that's taken some investors by surprise. The 10-year yields keep moving higher. Now, these are from my charts with a financial source, and the service is available for those who are HYCM clients. You can get access to this financial source terminal, and you can see some of the webinars I do each day there. Now, if you just take a look at here at the Fed Fund futures, what you can see, the December contract, this top contract here, are pricing in at 3 interest rate hikes for the Fed this year. The Fed themselves have projected 3 interest rate hikes this year. So that makes the Fed now the second most hawkish central bank behind the RBNZ. The RBNZ are projecting moving up to 2.6% around the end of 2023. So they're currently 0.75%. So they are looking at going on a hiking cycle. Okay. Now, the move higher in interest rate expectations has been building for some time in the US dollar. And if you just take a look at the dollar index heading into the end of last year, what you can see is that dollar buying has been taking place for some time, and we're now sort of stuck in this range, 95 to 50 up to 97. So a lot of this kind of expectations about the Fed hiking interest rates has been baked in. Now, the year has started with dollar strength, which is in line with the medium-term fundamental bias of the dollar right now. That's correct, and as it should be. But there's a question mark. Is this a little bit overdone? Now, we had the US manufacturing PMI data out yesterday, and it was a miss. And also notice that the prices paid component of the US ISM manufacturing also was a miss. Now, this is important and a focus of the market at the moment, because you see how it tracks inflation, the prices paid. So in other words, what manufacturers are paying is a good indication of where inflation's going. Sure, it's obvious, isn't it? If you're costing more to buy something, eventually prices get passed on. Now, that isn't always the case, obviously, because a company, just because it costs more to produce a product, they might think, yes, but we can't raise prices because we will, we will lose our consumers, okay? So it's not always the case, but in terms of manufacturing prices paid, you can just see here, look, as sure as night follows day, generally higher manufacturing prices paid result in, rising inflation. So this fall in ISM prices paid is interesting, isn't it? The central bank meeting after the Federal Reserve dropped the term transitory, or certainly walked back from it heavily. It is the time we start to see prices paid dropping, okay? And that inflation level, look, headline inflation, above 6%. Wow, that could start dropping lower in line with prices paid. Now, obviously, one swallow doesn't make a summer, one sandwich doesn't make a picnic, but this is not a surprise. And a number of analysts heading into the end of 2021 saying that future growth might look like slowing down. So that means the recent dollar strength looks suspect. Now, what would carry this dollar strength going on? One, if jobs, ADP jobs is a really strong beat, PMI data is a real strong beat for the services, NFP is a strong beat. Then we'd see yields pushing higher, like see the dollar pushing higher, and maybe even expectations of further interest rate hikes, sure. But yesterday we saw a miss in the manufacturing PMI. Manufacturing PMI makes up around 20% of US GDP. So services PMI make a significant larger proportions to service-based economy. So exactly what happens with this run of economic data this week is important. Now, we looked at the Monday, we've got manufacturing PMI, services PMI, ADP jobs, NFP. Now, that's the context. In that correct context, we can now have a look at what to expect from the ADP data. Due out at 1:15, just after this, and there is potentially some tradable opportunities. Now, it's expected to come in at 400,000. Now, many people say, most people realize that the ADP employment data is not great at predicting the non-farm payroll data, but what it is good at is setting the mood music. So it does give a good indication of what the market's feeling, what the anticipation is, what the mood is. That's important with so much dollar focus knocking around at the moment. So if the ADP data comes in above maximum expectations, you can see here 500,000 is maximum expectations, minimum expectations 300,000. If they come in above maximum expectations, then that keeps the sort of more bullish outlook alive. And that would be positive for 10-year yields, positive for dollar yen. So in that instance, the currency pair to look to trade would be looking at potentially more upside in dollar yen, and it could see some downside in equity markets. Now, my go-to pair for trading it would be here the dollar yen. And you can see that dollar yen broke out that 115, 50 region. We are now retesting that region, and we can see here we're sort of forming that potential inside bar. So a strong break on ADP data, we expect to find buyers and up to testing that 116.20, then potentially up to that 116.50 region tomorrow, or maybe even today, depending on how high the data is. But just notice here, you see the 10-year yield, see how closely dollar yen tracks it. Now, you may have been wondering why the yen has been so weak. Well, part of the reason has been the surge higher in 10-year yields. That's been weakening the yen. Also, more positive risk tone due to a number of studies suggesting that Omicron is, yes, more transmissible, but less deadly, particularly for those who are vaccinated. It could actually provide some protection for those who have been double vaccinated, had the booster, then catch Omicron, actually tend to have very good antibodies, according to a research conducted by some Japanese scientists, then have very, very good antibodies to respond to Delta and the other Omicron, the other COVID variants. So there is a sense in which, for some, catching Omicron once you've had 2 doses and a booster, according to these initial findings, yes, samples are going to be small, so we can't rely on these, but a number of different studies have been corroborating similar things. Belgium showing that Omicron is less violent in terms of its impact on the biological system, according to its studies on mice. Some Japanese and US scientists did a joint study, again finding that mice tended to be less harmed by Omicron compared to the Delta variant. There has been some other studies on humans showing that COVID-19 in the Omicron variant is less, is replicating less in the lungs and more in the upper respiratory tract. So yes, it's more transmissible, but it's less deadly because it's not going so deep into that, the human system. Of course, breathing problems has been one of the major issues caused by Omicron, and that's sadly what a number of people have died on. So all of this positive risk sentiment has just helped some in the market say, well, perhaps we should be more optimistic about growth. Perhaps the worst is behind. The Omicron risks are fading, etc., etc. So it's a two-way market, okay? And there's a couple of different narratives knocking around out there. But in terms of the ADP jobs, if the ADP jobs are a B, you'd expect this to keep moving higher. Just notice here, that's looking up, that's a potential trend line. So potentially got a breakout of that US 10-year yields. We have got a little break of this recent swing point. So look here. Now, conversely, if it's a very big miss, if the ADP jobs takes a miss, this could be a nice sell trade. Okay, looking to move back into that range ahead of the services PMI on Thursday and NFP on Friday. So there is some good two-way action that I'm seeing here. But this is dependent on above minimum maximum expectation. So the minimum expectation, it's below that 300,000 minimum expectations. If we get that below, then that can potentially look at a decent sell trade. I like the dollar yen. I do like that. The best opportunity that I see is positive risk environment, and a beat in the ADP would be best for an intraday long. The best medium term trade for sort of maybe looking for a few points back into that 114, 115 region. Maybe lower back into that 114.75 region. What you'd be looking at here is a miss in the data. Now, yesterday there was a miss in the manufacturing PMI, and what we saw was some sell-off in US stocks. I'll just cover that. Right. So the NASDAQ particularly sold off heavily. Okay. Now, the concern here is if we see another miss, we may see another sell-off in stocks, particularly in growth stocks like the NASDAQ, because do you remember back in 2019, if you remember, we saw a sharp sell-off in stocks around the fourth quarter of 2018. Now, where is that? Yeah, here it is. So we saw that sell-off in 2018, and that was on concerns that the Fed was going to be hiking too fast. Okay, so we had all the expectations that the Fed's going to be hiking, and then thought, well, hang on, growth is slowing, so stocks fall off. Now, if we have a similar environment, then we can see a similar sell-off in stocks. That would support yen. So if we see a miss in the data, look out for yields to drop lower and US dollar Japanese yen pair to drop lower. Let's have a look at the. So if it comes in below 300,000, okay, that's what we're looking at. And if it comes in above 500,000, then that makes the picture a little bit more bleaker, doesn't it? The best opportunity is with a miss, because remember, the base case is already expecting prices to move higher, okay? We're already expecting 3 interest rate hikes next year. We're already expecting, the Fed's expecting it. Fed fund futures are expecting it. Everyone's expecting it. So the less expected reaction would be to a miss. Now, oil markets are also worth considering as well, particularly post OPEC. So just taking a look at commodity markets, you can see that copper prices have been supported on some news from Escondida and Escondida mines in Chile. Remember, a lot of copper is mined in Chile, and there's been some production problems in a couple of the major mines in copper. That's just been just moving up higher. Also, if you just look at crude prices, what you can see here is that crude prices have been supported after the OPEC meeting yesterday. Now, there's an important couple of things to note about this. First of all, markets are quite upbeat in terms of what OPEC decided. There's no surprise in their decision. They've increased their output by 400,000 barrels per day. That was expected, but that in itself is seen as a positive message. Now, if you remember, heading into the last quarter, do you remember the concern about Omicron and the sharp sell-off we saw in oil? And if you remember, we suddenly saw that investors were starting to become scared that the first quarter and second quarter of this year would see falling demand for oil generally. And we had a test of this key trend line, but ultimately that trend line held. Okay, we had sort of a false break at that level, pushed forward, and it held. Now, what's interesting here is where we go from here. OPEC are confident that the first quarter and second quarter demand is going to pick up. Obviously, that flurry of initial scientific data about Omicron is positive, but it seems like, yes, it's more transmissible, but it's less deadly. So the headlines to look for is things like, say China reversed their COVID-free policy. They've got this policy at the moment in China that, if like they will not have any COVID in the nation. So that's the problem with that is as soon as you get a few cases, then you're having to lock down cities, towns, factories, etc. That means we're more likely to have supply chain issues. It's a risk. But if Omicron, and watch the data, watch the headlines, if you get more and more research saying it's less deadly, it's less harmful, then in that case, we might see China reverse their COVID-free policy. If China reversed their COVID-free policy, expect that to be positive for risk. So that would be like buy oil, buy Aussie yen, New Zealand dollar yen, those currency pairs, CAD yen would all be very good. Pro-risk pairs, CAD Swissy, Aussie Swissy, New Zealand Swissy, New Zealand dollar yen, Aussie yen, Aussie Swissy would all be excellent risk-on pairs to trade if we had that kind of headline. Now, where does oil go from here? Now, it's a little bit trickier. We had the private inventory data out yesterday. It was a draw of 6 million barrels per day versus an expected draw of 3 million barrels per day. So that's been supportive for oil. We've got the EIA inventory details out this afternoon after the ADP Jobs Data. Now, if we see another draw, I remember the way to look what's expected is the private draw was 6 million barrels. Okay, so with the private draw being 6 million barrels per day, what we'd be looking at here again to see more upside is we'd want to see a draw greater than 6 million barrels per day. So if the draw was like 7, 8, 9 million barrels per day, then expect that to be intraday long for oil. Now, the medium-term picture for oil is a more difficult picture. Okay, if inflation is dropping, if the US dollar is strong, that is all a negative for oil going forward. So in terms of oil prices from here, what we want to do is just recognize that we may be in this range for the near term until we get sort of a stronger driver moving one way or the other. Yes, the EIA inventory data may be suitable for some short-term trading, but medium-term, the picture is oil. It's still medium-term supported, but it's just a much harder environment now. So looking at production levels, looking at supply and demand, particularly the headline that would have me buying oil for a quick scalp higher would be just anything that's positive risk. But medium term, whether these prices can maintain above, sort of much above 85, it does remain to be seen. Okay, that is a genuine question that is out there. Another key market to be looking at is the one of the precious metals. Just looking here, just see what. Yeah, I do. Obviously, New Zealand dollar yen is a very interesting pair here. Just see we're coming above that trend line going back on the weekly chart. I do have a bias to buy the New Zealand dollar yen. I am long New Zealand dollar yen. I'm expecting this to break out higher. Obviously RBNZ expected to hike interest rates, up to 2.6% by the end of 2023. Bank of Japan, still on minus 0.10%. That's expected to remain the same for the foreseeable future. The only risk to this trade is, unfortunately, it's not an insignificant risk as well, which is yen strength on particularly risk-off trading. So if the Omicron variant results in widespread lockdowns through China, that's the sort of thing that could strengthen the yen. But any returns back to that 76 region look really good value for buying. So I would favour buying, strong buying from 76. Stops below 74.34. I've got my stops well out the way, right down here at sub 74. So any retraces back down there would be an opportunity for buying. Nearer term levels would be obviously stay above this trend line, stay with, get back below, get out, and then looking at 78 with stops below 77.50 would be another near term area. Ultimately looking for 82 and beyond. If you just look at this on a monthly chart, you can see, look, you've got a nice Harami inside bar false break. Now, when you see those false break of the Harami inside bars, they can be very, very powerful signals, particularly around sort of key turning points. And just noticing that, false break of Harami inside bar does open up the potential, for the first 3 to 4 quarters, maybe back up to 1992. So I think from a longer term trade perspective, you've got this longer term potential trend line going down from December 2014 to 2021, just moving above sort of, that region is significant. And if we can close above that trend line for the month, that would be great. If we can move back through 82, then obviously got that key overhead resistance here. So that would be a first target. But if price can move, back through that area, then it is opening the way ultimately for that 92, 94 highs from 2015. No reason why it can't get there. The major risk is twofold. One, a risk-off sentiment. If we start to see risk-off, this is in yen strength. Two, the other major concern is if the RBNZ move back from their more hawkish bias, or the Bank of Japan is forced to raise interest rates due to rising inflation, something like that. That will be the key risks for us to look at, and definitely ones to be looking out for. Okay, folks, I hope that's been helpful. I will be back here on Monday, back to my normal service. So we'll be getting ahead for the upcoming data points for next week as we really get going. 2022 is really underway now, so it's very seeing some action. ADP, get ready for that, coming out at 1:15. So I hope everyone has a really good trading session. Please do take care, and I do look forward to seeing you on Monday. Otherwise, have a very good week, and allow me to take this opportunity to wish you a very happy new year again. Great to have some familiar faces here with you, and really look forward to completing this in the future. Yeah, thanks, Warren. Happy New Year to you, and Happy New Year to you, Kingsley. Take care, everyone. Nikita, Jabin, have a really good trading week, and don't forget, I'm back here again on Monday. Thanks, everyone. Now, goodbye.